empowering the community. We do 4 things in all of our workshops. We want to give you hope that you can achieve whatever goals you have, whatever you envision, it's possible. So we have people come and share their story about how they've overcome some adversity and what they've learned from it. So we want to give you hope. We also want to inspire you to take action, because all of the knowledge in the world is not going to help you if you don't take any action, right? So take action on your ideas, be consistent and disciplined about that. And then thirdly, we're going to give you some education. So today, we're going to give you some education on life insurance. So that's something that's not a sexy topic, but it's definitely something that, you know, your loved ones will love you if you get some life insurance. So we're definitely going to give you some education. And all of the information that we share with you, the handouts that we reference, is below the video in the description via a link. So go ahead and click on that link to get the handouts that we may reference throughout our program today on life insurance. And the last thing that we'll do, which is very important, because nothing of significance can ever be done alone. So we are going to connect you to some resources. You're going to have some questions after this. You can definitely ask questions now. If you're online, go ahead and ask questions in the chat. But definitely we want to connect you to some resources after this to help you take the next step to achieve your goal. So that's what we're talking about today, but let's get this going. We're going to have a fireside chat. Normally I introduce the speaker and I get out the way and let them do their magic, but we're going to have a conversation around life insurance, and I like this because my friend Adam Keller is a certified financial planner. We worked together before. He has his own practice. It's called the 3 Oaks Advisory Group, but he's spending a portion of his life away from his family, and you know, his girls are playing some sports today in the afternoon, so it's perfectly working out. But we're going to have a conversation that we normally have with our clients around life insurance. And I want to talk about how life insurance is part of a financial planning practice. A lot of times as advisors, you talk to them about investments and saving money and, you know, achieving your goals of retirement, but life insurance is something that's very important. You have the luxury to have those kind of discussions about the future and creating wealth and generational wealth only to the extent that you have some safety nets in place in the event that you don't wake up tomorrow, which at some point we're not going to do. And also if we are not able to wake up and do the things we do to generate income. So life insurance is very important. I'll share some personal stories with me. But in the meantime, I want you to show some love for my man, Adam Keller.
It's good to be here with you, man.
All right. So like I said before, we have an audience here. And we also have some people watching online. I know my cousin, Becky from Houston. I'm giving you some shout out, baby. I love you. Thank you for supporting us. It's so cool. Like as a financial advisor, we help people we don't know. But in the event that we can help our family, you don't know how much that touches me. So Becky, thank you for being on. Any other family members as well, thank you for your support. But definitely, if you have any questions, don't hesitate. I got the live chat up. And as we go through and start talking about what life insurance is, do we need life insurance? How much do we need? What are the different types? All of the questions that you would normally want to ask, don't hesitate, ask questions. So thank you. Thank you for joining us, man.
Thanks for having me.
Always.
Like Clifton said, there's really not a lot that's sexy about life insurance. So the thought of giving you a monologue about it was detracting even further from the sexiness. Hence, we got to have this guy in the mix here. So perhaps with the two of us combined, there's a glimmer of hope here. And just to tout Clifton a little bit too, Clifton is 100% adept enough to cover this topic on his own. So I too am blessed that you've asked me to come and be a part of this with you and getting to work alongside Clifton. So much respect and love for this guy. And I think, like you said, getting to serve the people that we love is great, but getting to extend that circle of people that we know and we love is great too. And making sure that everybody's equipped with the same wisdom and knowledge and everybody feels comfortable being able to ask a question, I think is a big part of what we're here for. Because life insurance is one of those weird beasts too that has a lot of misconceptions and a lot of biases. And we all come from different backgrounds and we have different cultures. And culture leads a lot into the way that we view life insurance. Life insurance kind of emanates from Western Europe. And so it makes sense in certain cultures, right? But if we're coming from a Latin American background or from a different background, sometimes we view this as maybe not something that is a typical tool in our toolkit. And it can be, and it's not for us to impose it on anybody and say you have to. Mm-hmm. But I think like Clifton said, at some point we're guaranteed to not wake up. And the question is, how do we have those conversations with our family? How do we think a little bit about that morbid side of things and have some degree of a game plan in there. So if we can help answer some questions, help potentially lay some foundation for that, awesome.
Yeah, and then also, just to let you know again, there are 3 handouts that you should have in front of you. One of them is entitled Types of Life Insurance. And like I said before, if you're online, go into the description section either now or later. And this is going to answer and give you a lot more information that we'll probably be covering now in the program. But you can always watch this again, contact me, put your questions in the comments. But this talks about the different types of life insurance. And then you have another document that's a little bit more, it's 9 pages. It says Life Insurance Basics. So this goes through more explanations of the different types of life insurance, temporary life insurance, permanent life insurance, and then the different types of permanent life insurance and how cash value grows in it. And then the last piece is on a different type of permanent life insurance, which is called the Index Universal Life Insurance. That is getting a lot of attention now. So those are the 3 handouts. And like I said before, the way we're going to structure this, I'm going to talk about or ask Adam some questions around, do we need life insurance? And then we're going to talk about the different types, how much do we need, the cost of life insurance, and then using life insurance to create generational wealth. So the first question, and I know I tell people this all the time, like, do you need life insurance? You talk to somebody who's like, I have a kid who's 24 years old, no kids. I have a daughter that's 38, not married, no kids. And I am actually paying for life insurance for them because I know that it's not on their radar today. But they probably don't feel like they need life insurance. And I say that nobody can tell you what you need, but how do you address that question when you're meeting with clients, and how do you introduce life insurance and whether it's even a need for them in their plan?
I think that's a really good question, and there's not a one-size-fits-all approach to life insurance. It's kind of easy when you get into the numbers side of it, but the difficulty is on the qualitative side and asking the questions around, what if you're not here tomorrow? What's important to you for the folks that you leave behind? And for your son who's 24, you may be going, I mean,
I'm good. Y'all
not much. And part of that is going, you're right. Today, technically, you don't have a need. Then the question becomes, well, what's your 3 to 5 year plan? What's your 10-year plan, right? And none of us know exactly, well, am I going to get married in this many years and have children and take on a mortgage and these kind of things? But typically, we think the more responsibility you have, potentially the greater your need for life insurance. But we also say, life insurance fills the gap where our assets are short, right? If we have $3 million sitting around in cash and we've got a mortgage paid off, Sandrina's smiling, she has $7 million in cash. We will talk to her later. You know what? Then your assets may be sufficient and your need for life insurance is also diminished. So it's not just based on your age, it's also based on what are the other things that you have at your disposal, right? Maybe you're married and your spouse makes equally as much, if not more than you, and could cover all the bills in the household if you weren't there. Arguably, need for life insurance may not be high unless maybe we're behind on saving for a kid's education or retirement. So, Clifton, I think you're like, it's a classic financial advisor response. We just answer a question with a question, or it depends. So on helping somebody assess their need, part of it is really what is their goal?
Right. Right.
And again, I think I've had plenty of conversations. I'm an old international business major. Spanish is my minor, so I'm gonna keep on leading into our Latin American community. I have a lot of Venezuelan clients, and in some of those conversations, it's, you know what, my faith is what takes care of these things if I'm not here tomorrow. And I think that's a beautiful response too, right? And so I think letting them know there's a financial tool if we need and we want to use it. Your faith is a great, important piece in your long-term planning, and arguably things that are more important than the monetary aspect of it.
Right.
So yeah, I think it always starts with that conversation on what somebody's goals are and what they would like to see happen, and then we can help them accomplish it.
Well, and then the other thing I do here is I encourage everybody to meet with a financial professional. It's amazing. It's whether you're young, you have a lot of money, it doesn't really matter. There are people who are not meeting with financial professionals to put some structured thought to their finances. And whether you use a financial advisor or not, but talking to someone who has met with thousands of other clients who have seen a ton of different situations, they can add value by giving our input to how you can help, how we can help you achieve your goal more efficiently. So before we leave that topic of whether you need life insurance, I do want to talk about categories of people. And I want to start with the fact that as grandparents, when we have kids, we normally buy life insurance for our kids. So that's before they can even think about it. Like, do they even have a need? I don't know, but the parents do. We don't want to talk about this, but there's two things. Number one is, if there is a premature death, there's a cost to that. The people who love you are going to incur some cost. Cost to either, your burial costs, your final expenses, or even to just handle some of your stuff. Like my son is 24. If he was to pass away, I'm not speaking anything into existence, but if he was to pass away, he has a place in Boston right now. So family will have to take time off of their job and go to Boston and take care of his stuff. And so if you care about people who are going to be impacted by you passing away, you may want to think there might be a need. Or let's say for a child or grandchild that life insurance to be bought for them, we don't want to think that they're going to pass away.
Right.
And so let's say they don't pass away, they live to be older. In my age, I wish I had more life insurance. So one of the biggest gifts you can give someone is a life insurance policy that says, hey, whenever they pass away, even if they live until 80 or 90 years old, they have life insurance that has been purchased when they're young and healthy, and that's valuable. So talk a little bit about, regardless of them being in need of having kids or people dependent upon them, having life insurance early when you don't really have a traditional need is beneficial because it's less expensive and you're healthy.
I think that's a great point, and kind of goes to your son's situation as well. At 24, the monetary need isn't necessarily there, but I think the two basic concepts in insurance are your need, but also your ability to qualify for the coverage. And when we're young and when we're born, pretty much no insurance company is going to deny a baby life insurance because the actuarial math behind the likelihood of a baby passing that year is next to none. As we get to be 84, the actuarial likelihood of somebody passing away is much higher. So you're more likely to not get the coverage or for your coverage to be really expensive. So I think it's always that balancing act of when someone's young, being able to get that coverage in place when you know you're going to be able to get it is a really important factor. And I'll give an example. I think like Clifton said, the longer that we do this, the more stories we have. We had a young client, mid-30s, that was going on assignment to work in another country. And so we had gotten estate plan in place and done those kind of things and went through the process of starting to do some underwriting for life insurance. But life is busy, had to do a lot of prep to go overseas. And we decided, you know what, we'll wait to do that until you get back in 3 years. In that 3 years, she's diagnosed with cancer. That all of a sudden becomes a big strike when she tries to go get life insurance. And basically, she was uninsurable for the next 5 years after that. Now, I think that's a really important piece, too. For somebody that's going through cancer, don't think that you are never able to get life insurance again. There's typically a 5-year period after your last treatment that they want to see you sustain certain levels and things of that nature. So I think that goes back to the idea of working with a professional. And it's uncomfortable disclosing some of these things that we hold close, but the more the professionals know, the more they can source it out to different companies, and not every life insurance company will treat you the same. So Prudential may look at you this way, but New York Life may say this, Nationwide may say that. So sometimes we can shop the insurance companies against each other too, to come back and try to fit you best, right? And be your advocate on your side of the table. So I don't know if that helps in terms of kind of age and how it factors in, but I think the one thing we can't control is our ongoing, well, there's a lot of things we can't control. How long will Adam talk on this subject? But I think it's that idea. We don't know what tomorrow holds. So while you can get it, sometimes it's good to plan in advance. And then we want to be cognizant of, you mentioned earlier, is it term? Is it temporary?
Right.
Is it permanent? Because maybe sometimes if you get it too early and your term expires before you do, it may become really expensive in 20 years to keep that same level of coverage. So understanding the types becomes important too.
Yeah, and we're going to go deeper into that. But before we leave the topic about do you need, this is big with me. So not only when you have somebody who's young, when you have somebody that's single, they're not married, they feel like they don't have a need, I still feel like it's important to have a conversation with a financial advisor to discuss about what are your goals, when do you think you'll need it, and like I said before, nobody can tell you that you need life insurance, but we can ask you questions so that you're putting more structured thought to it. So I want to talk about what are the traditional reasons why people get life insurance. So let's say they are married, or they have kids, and they have people who are dependent upon them, And if they were not to wake up, their loved ones will deal with some financial burdens. So what are the traditional reasons of why people need life insurance?
Yeah, I think it really ties, early in life, it ties to that idea of responsibility. So if you are responsible to a significant other, to a spouse, to a child, maybe even taking care of an older dependent, a mother or father who's come back in the house, and those folks are relying upon you and your continued generation of income to help cover matters financially, life insurance need typically is higher than. Let's say we've also taken on a mortgage where if we pass, now all of a sudden, not only were they relying on our income, but there's debt that has to continue to be paid. And honestly, regardless of the mortgage, there's probably rent that needs to be paid, these kind of things. So I think initially, responsibility is what really initiates or instigates that need for insurance. The more responsible you are to others, then the higher degree or the likelihood is that you need life insurance. I think as we get older, and even before that, it's goals-based. So you may not be responsible, but you may have goals to, maybe you're super charitably inclined and you want to amplify your ability to give a gift to a charity. There's a lot of cool ways that you can give a gift to a charity, but one of them is you could buy a life insurance policy at a really young age with a really high death benefit and have pretty low premiums. Well, at your passing, that death benefit could go to the charity, right? And
Empower Series. Oh, I'm sorry.
501c3. It was just North Texas Giving Day.
Who said that, right?
Yeah. Make it happen.
Right.
So goal at the young age, and then also as we get older, some families have done a really good job of, let's say, amassing real estate, right? And real estate is illiquid, right? A life insurance death benefit is liquid. And sometimes we use these terms and maybe people are going, what are you talking about, right? Liquid like this, the water in my glass is free to move around. I can kind of, if I tilt the glass too far, it's going to spill out. It's free to move everywhere. Illiquid is like if this was frozen and it can't move as easily, right? It's hard, it's rigid. Think again that life insurance death benefit that comes into your beneficiaries, they can use it to do whatever they want to do. And when we've seen families amass a lot of real estate or a big portion of their net worth is in their real estate at their passing, if they leave that to their family and the family behind them has no ability to continue to pay for property taxes, insurance, do renovations, sometimes that family is forced to sell that illiquid asset. And when you get forced to sell real estate, guess what the market does to you?
Takes advantage.
Yes, yeah. Right? And so that life insurance now all of a sudden, instead of taking care of responsibilities, it just gives your family flexibility, especially if you're passing illiquid assets that you want them to be able to maintain in the family. Maybe it's the family home where everybody came for reunions or whatever it may be. Let's not be forced to sell that and sell it at a rate that's less than what you should get. Life insurance can come back in and help keep that asset in the family. It can also be used to pay estate taxes, right? So I think on one of these, as a matter of fact, it's on the handout, types of life insurance. At the very bottom of it, it references what's called an irrevocable life insurance trust. That is a really cool estate planning tool where you can hold a life insurance outside of your estate so that it avoids estate taxes. And the attorney that helps you draft the trust will put some verbiage in there that says that could be used to come back in and help pay estate taxes, right? So again, that's the idea of maybe you own a business or you own real estate and you don't want your family to be forced to sell it. That piece outside of your estate can come back in and help keep those assets in the family and avoid estate tax. Estate tax is 40%, so we think, oh man, I hate paying income taxes. Well, the highest income tax rate's 37%. Mm-hmm. The estate tax starts at 40%. So when we can avoid that, that's a good thing. And Sandrine's the only one in the room who has to worry about that because it doesn't start until you're at 13 million in net worth or gross estate. So anyhow, does that help a little bit?
It does. And so we're spending some time on this because it's worth, I believe it's very valuable for you to put some thought to what are your needs. And a lot of times people think about passing away and I need to take care of other people who are my loved ones who are financially impacted by my passing. But the other reason is to transfer wealth and to accumulate wealth, generational wealth. So we'll get into more examples of that. But it goes back to where nobody can tell you what your needs are. We can ask you questions, you can put some thought to it, and we can spark some insights to where maybe you do have a need that you just weren't aware of because you never met with Adam, right? Or never thought about it. And so I want to go into now the different types of life insurance, because now if you feel like there's a need, or you feel like you may have a need in the future, again, it's worth talking about to educate yourself on the different types of life insurance policies. So we know that there's basically two types. There's temporary insurance and permanent insurance. How do you explain the different types of policies, Adam?
Yeah, it's a great question, because even on the handouts you can see as you run through here, there's a lot of different subtypes in there, and this is not an exhaustive list. For instance, when you buy a house and you first get your mortgage, there's term that can just cover your mortgage if you pass. There's group insurance through your company, right? And so that's a type of term or temporary insurance. And sometimes you can get a group universal life. So to start out, Clifton, I think that dichotomy between temporary or term insurance and permanent insurance is a really interesting point. And I think both of them have a place in your financial situation. In the beginning, when we don't have a lot of assets, term insurance can be a really cost-effective way to cover a need when that need is really big. But you mentioned your son's 24. My daughters are 12 and 15. So right now, if I passed away today, my wife is trained as a social worker, and she works part-time doing some bookkeeping for the church. But her ability to earn an income at my level would be really strained. She wouldn't be able to stay focused on the kids the way that she is today. So my insurance need right now is really high. When my kids get to the point where they're out of school, they're out on their own, and they're not on my payroll anymore, my need's coming down. So term or temporary insurance is really good for those finite periods where you go, you know what? For the next 10, 15, 20 years, I need to have this coverage in place. And I'll give you an example. Like I have $1 million term policy. It costs me $80 a month. I'm 44 years old. Okay, I just renewed my policy last year when I was 43. And I was just doing some math, okay? I think before we get into the permanent insurance, the key thing about term insurance is, you probably hear the adage, buy term, invest the difference. The key is you're not done when you bought your term insurance. The term insurance is buying you time to be able to plan adequately in the way that you build the rest of your wealth towards your goals. Because remember, back to the initial concept, insurance in this case is there to make up for a shortfall in assets today. But if that cost me $80 a month, if I invested that $80 a month at 7% for that 20 years, it would amass about $44,000. So over 20 years, if we look at that, we're like, that's a pretty big price tag, right? I could have had $44,000, but if I passed away any point in that time, my family would get $1 million. So I think that's a pretty good bang for my buck. It's $80 a month. The question then becomes, what am I doing with the rest of my income? Am I building in the next 20 years ample assets to help cover my family or cover my goals if I'm not here? I think that's the key. So I think term is great and that it is cost effective. It is for a specific period of time. And there's a lot of different variations of term. Again, you can have annual renewable term. You can have a 20-year term. Lots of different stuff. So the devil's in the detail on that. And we probably can't fully educate everybody on those. But just think term, temporary. What are you doing with the money so that when that term ends, you're ready to deal with that? So on mine, for instance, the premium in 20 years when I'm 64, it'll probably go from $80 a month to about $600, $700 a month. I probably don't want to pay that premium, right? I hope I'm still alive, but I hope I don't need my insurance anymore because I'm not going to pay that premium. So I think that goes back to that idea of let's not get complacent when we buy it and forget that at the end of that term, it's not that your policy expires, it's that that fixed premium expires and now it adjusts upward because back to that actuarial math, you're 20 years older, the likelihood of you passing is higher, so the insurance company is going to charge you more to keep that coverage.
Okay, so I want you to touch on permanent insurance, but don't go into the details yet because I want to go back and talk about how do you determine how much. So we know what temporary insurance is. Temporary insurance is anything that's not going to last your entire life. Well, we don't know how long you're going to live.
Yeah.
So it could be 1 year, it could be 5 years, 10 years, up to 30 years, or it can be your work insurance, which is temporary. It's just, there's going to be an ending to it at some point in time. Talk about permanent life insurance, and while you're doing that, my phone is going to die.
Okay.
So, has a short life. I'm going to go
You
get
have term insurance on your phone.
No, that's what I'm thinking. I'm going to go get my PC and put it up, but answer what permanent insurance is generally, and then we'll come back and talk about how do you determine how much and how can you satisfy with either temporary insurance or permanent insurance.
Clifton, you don't have to lie. I know insurance isn't sexy, but you don't have to run away from your own show. Will was going to run away, and Will's still here.
I'll be back.
Come on.
I'll be back. I promise. I promise I'll be back.
I love it. So, look, and I'm making jokes, and then I forget the question. So I'm going to be talking about permanent insurance.
At a high level.
At a high level, okay.
We'll get to the details later, man.
All right. I'll stall if it takes you longer to get your computer. All good. So, like Clifton said, a term policy, to contrast them, is going to, quote unquote, end at some point. Technically, you can keep it in place your whole life. It's just your premiums become exorbitant. Permanent insurance is meant to be with you for your entire life. And so typically what happens is it's going to have higher premiums in the beginning than what you would pay if you were just going to get a term policy. But over time, those premiums should stay level. So if you kind of envision a timeline, and this is early, this is late over here, when you're early and you buy that term policy, your premiums are down here, but the permanent policy premiums are up here. So they're going to be higher. But over time, what's going to happen is those permanent policy premiums are going to kind of stay level. And the term policy, if you want to keep it in place, is going to become more expensive. So it enables you to plan for something that you can keep in place your whole life. And because those premiums are higher in the permanent insurance, if you fund it correctly, it can be building cash value inside of the policy. So Clifton mentioned as grandparents buying policies for grandchildren. A lot of time these are going to be permanent policies for the kids where at some point they're fully paid up and the kid's going to have some degree of cash value inside of there where they can do whatever they want to do with it. If they want to keep the policy in place, great. If they want to cash it out, they can cash it out. So think permanent, think it's meant to be with you your whole life. When Clifton and I were coming up in the advisory realm, they used to say, life insurance guarantees against the one thing that you know is going to happen. We're all going to die at some point. The question is your coverage still in place when you expire, right? So permanent policy is meant to do just that. It's meant to always be with you. A term, think back to that, it's for a temporary need or for that period in your life where you think my coverage need is higher. I don't want to sink all my money on a monthly basis into these permanent policy premiums. I want to be able to do other stuff. Term's great for that. Permanent's better for that kind of base level of coverage that you say, you know what? It'd probably always be good to have some money behind here to help my family out to do whatever your goal may be.
Good. So that's a high level understanding of the different two types: temporary policy, different terms, and then you have a permanent policy, which is intended to be enforced whenever you pass away, no matter what age you are, right? But before we get into the different types so that you can understand which one you use, I think it's important to identify how much you need, right? Because when you look at your need, then you may have to use a strategy of a combination of both of them. For someone who tells you that you only need permanent policy or you only need temporary policy, that's not the case, right? There is a question online. I'll ask that question, but there's a question in the audience. So what do you have, Mary?
So once the term insurance expires, what is the percentage rate that it escalates versus the fixed premium?
Okay.
That's a
Let
really...
me repeat, I'm going to repeat
Yes.
the question that you can answer.
Uh-huh.
So Mary asked the question, when you have a term policy and you have a leveled premium for a period of time, like 5, 10, 15 years, and then it expires, what is the percentage of increase is the cost? And so it does vary, but Adam, how would you answer that?
Yeah, that question is really important from a long-term planning perspective. And so it depends on different factors. Again, classic financial advisor, it depends. So Mary, as a woman, your life insurance coverage typically is going to be less expensive than mine as a man because men are expected to die before women. Women have a longer lifespan. So your jump should be less than mine, right? It also depends on what's your age at the end of that term. If I bought a 5-year term today versus a 20, then in 5 years when my term expires, the premium jump won't be as much as mine will be when I buy a 20-year term because, again, I'm older by the end of that term. And one way you can arm yourself with that information is when you're buying coverage, ask the agent to give you the illustration. The illustration will also almost always be in your policy itself, at least this portion of it, and it will show you what they expect that premium to jump to when that term expires so that you mentally know. And by the way, even that is an actuarial guess because they're always updating actuarial tables. So in 20 years when mine expires, my policy tells me what it's expected to jump to. The actual premium in that 20th year may vary a little bit depending upon what we're seeing as a nation in terms of mortality rates and longevity and stuff like that. But the illustrations are a great place to go to get that exact answer.
And the other thing I would say, in my experience, whatever increase if you want to keep the existing policy, the increase is too large for people to keep it.
That's a great point.
And so what you do before it ends is you can either convert some of the amount of coverage to a permanent policy or just reapply for a new policy, but realize it's going to be based on your current health condition and your age. It's going to be more expensive, but typically it's not going to be as expensive as trying to keep that policy where the term has ended. Because those term policies are not really designed to keep after they've expired.
I think that's a really good point. And again, I apologize because insurance, there's a lot of complexity to it. It's not an easy beast to wrap your head around.
So let's talk about it real quick then.
Yeah. You're going to be pros. Clifton mentioned a term that I think is a really important one, which is that idea of convertibility. So I might have that $1 million term, and in 20 years, I shouldn't need $1 million in insurance, right? So a conversion feature or convertible term insurance, as it says on the second page or the third page of your types of life insurance, that enables you to take a portion of that term coverage and make it permanent. So I could take $100,000 out of my $1 million and convert it to permanent insurance so that I always keep that and I don't have to go back through underwriting. And that's a convertible term feature. So if you're going to buy term, I would ask that question to your agent. Does this have a conversion feature? Sometimes that conversion feature expires before your term does, right? So my term might be 20 years, but my conversion feature might expire after 7 or after 10. Sometimes it's completely aligned with your term and it expires at the end. But it's good to ask that question and to know so you can build that into whatever planning you're doing and evaluating, am I still going to be able to afford that? Do I want to keep paying it? That maybe help you have some other options than just keep it as is or let it go.
Let me repeat the question.
Yes.
So the question is, if you have an option of buying 1 year, 5 year, 10, 15 year, is it better to buy the longer term? And I'm going to see how you would answer that before I answer it.
Yeah.
How would you answer that first?
I think this is beautiful too. I love this. We think about being collaborative with clients and their other professionals, right? So sometimes it's like Mary was helping us prepare some awesome food back there. When you get too many chefs in the kitchen, we get too many different recipes, right? And then you're left wondering like, well, which one's the right one? Mine's the right one. Don't listen to Clifton. I'm kidding. I think to your point, we would have that conversation and look, well, what's the difference in those premiums, right? Is the 5-year $20 a month, but the 15 years $300? What would you do with the difference, right? How long do you expect this need for insurance to be exactly what it is? Are there also factors going on behind the scene where in 5 years, your mortgage is completely paid off, or your spouse goes back to work and all of a sudden he or she is earning like 2 times what they're earning today, so all of a sudden their reliance upon your income is less. Like what's happening behind the scenes in the 5 years, in the 10 year, and the 15, that should help us. What's the premium differential? My tendency is to say if the premium differential isn't huge, go with the longer term. You can always cancel it after 15 years. Just because you bought the 15 years, you don't have to keep it for that. You can keep it for 7 and go, I'm good. I've got all my other stuff taken care of. I'm not paying that premium anymore. It's out. But if it's a 5-year and all of a sudden you have to go get underwritten for a new policy or renew and it's higher, that may be tougher. So that's kind of the way that I look at it. Does that help? Okay.
Okay, so the way I would answer that is it depends on your goals.
Look, I was trying not to say it depends again. I wanted to as well.
but those are some great examples. It really does depend on your goals, and you have to sit down with someone to really make sure that there's clarity on your goals and you see the different paths to achieve them. And I want to go into a conversation about how much life insurance do I really need? Because what you'll find out when you calculate the actual need for life insurance, it may be at a level to where you cannot accomplish that goal of your need with permanent insurance.
Right.
And then you have to have a split between temporary and permanent. And then you get into the strategy of how long do you have your term insurance? So go through some examples, Adam, of now we feel like, okay, there's a need for insurance, but how do I determine how much I need now and project in the future how much I might need? How do you deal with that with your clients?
Yeah, I think that's great. And there's a lot of different ways to arrive at what your need is. So, for instance, there's a concept called human life value. And what that says is, look, if your life stopped tomorrow, what's the economic impact on your family? How much were you bringing in on an annual basis? And how much would you need in a death benefit if it were invested at a reasonable rate to generate your income every year for a certain period of time for your remaining family? That's kind of the way the courts would look at it. If you were, let's say you were wrongfully killed and an attorney were helping your family to sue whoever killed you or whatever happened to provide money back to your family to make up for your loss, that's the way the courts are going to look at that. That's typically going to arrive at a pretty big figure, right? So let's say we're making $100,000 a year and we can invest that at 5% and generate this 5% income stream. If we divide 100,000 by 5%, that means we need a $2 million death benefit under this human life value side of things to generate that 100,000 a year for a certain period of time. That's a pretty simple calculation. We're not taking into account you getting raises or any of this other kind of stuff, but that gives you one way to arrive at that need. Am I going to replace my economic impact to my family? Another way to look at it is to kind of think about, back to that idea of responsibility, what are the things that you would want to accomplish, right? So, for instance, I have 2 children who are going to go to school. Hopefully, I don't know, maybe they'll go to be in the trades, and that would be awesome too. But if they were going to go to college, it's pretty easy to figure out what the cost is per year for college. Like, for instance, I went to UT at Austin. Right now, it costs $30,000 a year with tuition, room and board, and all that stuff to go to school. So 4 years of that, let's call it $120,000. But they're not going to school tomorrow. So in insurance needs, we want to look at what that future cost is going to be. We want to bring it back to a cost today, assuming, look, if we had a life insurance death benefit, I could invest it for 3 more years for my 15-year-old, 6 more years for my 12-year-old. So I don't need $120,000 for each of them today. I need a smaller amount that I could invest, let it grow, and it'd be available. And do I need the full amount? No. Maybe I'm going to tell them they got to go get some scholarships. So maybe I don't need $30,000 a year. Maybe I need $15,000 a year. Things of that nature. So if we think about those things we're responsible for, I have a $250,000 mortgage. Do I want to fully pay that off for my family? Or do I want to give them 2 years worth of those mortgage payments in a death benefit so they have a 2-year period to feel really comfortable in the exact same lifestyle they're in? And then they can make decisions on, do we sell the house or do we keep it? Things like that, right? So I think you can start out with those and then you can subtract out anything that may be helping to offset your loss. So again, if you had a spouse or significant other that's also contributing and building and taking care of the household when you're not there, then maybe you don't have to cover as much because you know, even though you're not here, there's still going to be something in the household left behind. So we'd start with our responsibilities, we'd subtract out our resources, and then that would lead us to what we need in the way of life insurance. And I don't know that it's super helpful, but there's kind of a visual on that in that piece too, right? And it says current and future financial obligations minus spouse's earnings, savings, investments, life insurance you already own equals your remaining life insurance need. And I think this need changes. I think that's an important piece too, is that you may assess it today, and in 3 years it may be very different, right? And kind of like to Mary's question, what's going on behind the scenes is an important piece too, and how much are we continuing to build in wealth? How much debt are we paying off? How many of our children are off our payroll, right? So lots of different things happen that will change and affect that need as well.
So to summarize that, it sounds like there's your economic value. So take your earnings and divide it by whatever rate of return against that you would apply, and it gives you a certain dollar amount. So that's one way of doing it. Another way that Adam just explained was more detailed. It's identifying your goals. So do you want to pay for your children's education? You want to pay off your mortgage, any debt? You have any other obligations? You want to replace your income for a certain number of years until your family can get up to speed? So there's a more detailed approach, and then you can minus your existing assets against that. So having a conversation with financial advisors is important to do. But then there's also a rule of thumb, right? So some people say, well, 10 times my annual salary, or so many times your annual salary. So there's a lot of different ways of coming at it. One of the things that's not really, I think, is reflected in whatever amount you come in, or you calculate, because the goal is for you not to pass away. And so when you look at your need as of today, I would say that might cover you within the next 3 to 5 years, but it doesn't include inflation.
Right.
Because if you live into your 80 and you get insurance when you're in your 30s, then that $2 million is not going to be the same economic power in your 80s.
Correct.
And so it is important that you meet with a financial advisor, in my recommendation, every year. You don't wait so many years. You meet with them every year, just like you go to the doctor. You reassess your situation, reassess your coverage to make sure that it's still appropriate, or whether you need to change anything. So those are the two things I would add to that.
Yeah, and I think to that point, we use those rules of thumb, and I don't think those rules of thumb are bad. That's sometimes a simple way to go. I've got a lot of plates I'm spinning and managing, and I don't really want to spend a ton of time figuring out exactly what this accurate need is. But if I go, look, if I pass and my family has 10 years worth of my income, I am really confident that my family is smart, and in 10 years, they can figure out what they need to do to make things right. Okay?
Without me, right?
Yeah, I'm like, okay, is it cost effective? Did we get it done? Great. Is it owned right? Do I have the proper beneficiaries in place? And then I would say, as a beneficiary, also don't feel like when you get a death benefit that you're responsible for going in and doing everything on your own. I'll give an example. So 55-year-old client, husband and wife, 3 kids, all 3 kids were in school and college, husband passes at 55. And we had a $1 million term policy on him, the death benefit comes in, we had about $140,000 in his name and not in yours. Had she not had that attorney in there, she would have spent $140,000 of that $1 million death benefit paying off debts that were going to be written off anyways, right? And so I think be cognizant of that. Sometimes we feel the need to immediately disperse this big death benefit that came in. Take time, right? Certain things you have to do right away. Like you mentioned the funeral expenses and things like that. They need to be paid, and so you're going to need to pay them. But maybe also, if you have a mortgage at 2.8%, maybe don't use your death benefit to pay off the mortgage. Keep on doing that. Mortgages today are at like 6%. They've come down a little bit from their highs. Keep that mortgage in place. And if I have a $250,000 death benefit and my mortgage payment is $2,000 a month, that's 100 months worth of my mortgage payment. That buys me a lot of time. I don't have to pay the debt off. I can just use that to help me be more solvent in dealing with what's left. So maybe that's one other piece is engage some professional help if you're the beneficiary and you're having to manage in the aftermath of the emotional loss, but also then kind of getting all the financial pieces in place.
Yeah, and the biggest, one of the takeaways from this is forming relationships with professionals before you really need them. So not only is a financial advisor an important person to have in your Rolodex, but an attorney for estate planning purposes is important. So you have a financial advisor, but then there's some financial advisors that don't offer insurance. And then there's certain insurance agents that don't offer financial advice. So you might have to have a financial advisor and an insurance agent. But again, develop the relationships with professionals that you trust who can give you advice when you're going through these type of life changes. What I want to talk about now, though, are, before we get into the different types, again, the cost of insurance. So now you've identified you have a need. You realize that, okay, there's a calculation, whether it's $1 million or more, and I never find that when someone passes away and they look at the life insurance benefit, that they feel like, oh, I got too much money. Right? It's usually like, man, we should have got more, or something like that, right?
Right.
So let's just say $1 million is a starting point. Because anything less than $1 million is like, really? I don't know why I'm laughing at this, but
Why are we so morbid today?
right.
Saturday.
Well, right, exactly. So let's just say you identify that there's a need, whether it's $1 million or more. You got to think about now, how much does it cost? And when you look at the cost of insurance, we know that from a cash flow perspective, a temporary policy is not going to cost you as much in dollars on a premium basis than a permanent policy, because you're getting two different things.
Right.
You're getting a coverage for a temporary perspective as opposed to a permanent perspective. I think it's interesting. A lot of times when people look at a temporary policy, one of the negative thoughts around it is that I've paid so much into this policy, and when it ends, I get nothing. And I relate that to auto insurance. Like, we pay auto insurance all the time, and we don't pay auto insurance and say, man, I paid all this auto insurance and I didn't get into an accident. It's like, no, we don't want to get in an accident. So the idea when you buy this life insurance policy, they might have other opinions, but you yourself do not want to die within the term. You would prefer to live, right?
I mean, unless you're trying to maximize your return, and then you should die the day after you buy the
if you
policy.
care for other people. So to be upset because you paid into a term policy and you did not pass away, the goal is not to pass away during your term. Your goal is to live a long life, but the risk factor is what you've covered for. So I just wanted to bring that up.
I think that's a good point, and that's our hope too, right? Is that this is really just for peace of mind and the what ifs. And it goes back to that idea of what are you doing in the meantime, right? Tomorrow's not guaranteed, but if it comes, let's kind of have had some degree of a plan. Let's enjoy life today and don't put, I think this kind of goes into the idea of the cost. It's really easy to sell a really big permanent life insurance policy. There's a really big commission typically that goes with that, right? As the agent or the advisor. But clients have other goals. We don't want to put everything that we have into an insurance policy premium. And so I think if we're going to use the term route, just be cognizant of that, and let's be good stewards of the other money that we have and what we're doing without it. And I think on the cost side of things, again, the cost really 10-year term, right? So there's going to be some cost differential there. I'm just kind of a big fan of giving actual examples. So I told you guys I have $1 million term policy and I pay $80 a month for it. I have about a $278,000. It's really weird when you get into permanent coverage. It's not always like round numbers. Like a $278,000 permanent policy that's an indexed universal life policy. And I pay $230 a month for it. And then every now and then I'll throw in like an extra $1,000 to get it up to about $4,000 a year. So if we're doing 80 a month, what's that? 8 times 10 is 800 plus 16, $960, right? $960 a year for my $1 million term, or $4,000 a year for my little $278,000 permanent policy. So that kind of gives you that idea in the illustration before, around in the beginning, term policies here, permanent up here. But over time, remember what I said, like at the end of my 20 years, it's going to go up to like $600-700 a month. Now all of a sudden, that $230 looks really nice when I'm 60, and that term policy is up here, right? It's $600-700 a month. And in the meantime, I'm building cash value inside that permanent policy.
Yeah. So what he just talked about was a strategy to cover your need with a combination of temporary insurance and permanent insurance. We're going to go deeper into that, but I want to talk about the baseline factors that go into the cost of your policy, which is based on your age and your health.
Mm-hmm. And your gender, right? We talked about that idea before.
And it could be your career.
Yeah, great point.
So those are the things that you need to consider. So the two things that we know for sure, or the three things, is your gender. That doesn't change. Well, wait, it can change, right? Just to be clear about that. But the two things that may not change at this point in time is your age and your health condition. So I'll give you an example with me. So in 2015, I'm working. Wait, is 2015? What was I working in 2015? Was I at Ameriprise? I wasn't at Ameriprise. I was at Ameriprise. So it would. Oh man, this was like in 2000. This is like in 2009.
Yeah.
Oh, that's a long time ago. Look, my memory's already showing right now. But here's my point is.
Now we're going to talk about long-term care insurance for this guy.
That's enough. Don't get me started. But yeah, in 2009, man, time flies. I don't know why I was thinking 2015. Yeah. I found out that I have a heart condition. My left ventricle wall is thicker than normal. There's a term for that, but I'm not going to try to pronounce it. But I found out during underwriting. So a lot of times when we talk to clients and we kind of give them a quote of how much life insurance is based on their age and then an estimate of their health condition. Because everybody has to go through not everybody, but most people have to go through a medical underwriting process. And so when we give a quote, we usually give an average health. We don't say you're in perfect health or you're in worse health. We say it's average and say that it could come back with a lower premium or a higher premium. And so it's good if it goes come back lower. Hey, you're healthier. That's good news. But then if it's higher, we got to how do we spin it? So we go good news, you've been approved. But that quote I gave you is it's actually higher. And that's not bad. It's just, what that means is that there's a higher likelihood that your family will be using these benefits. Sooner. So it's so funny. It's interesting when you're on the other side of that. So that's what happened to me, actually. So I did a quote for $1 million policy, and then the underwriter called me and said, "So Clifton, when's the last time you've been to the doctor?" Why? What's up? And he couldn't really tell me. He said, "You should go to the doctor, man." Right. And so when I went to the doctor, I found out that I have this heart condition, which rated me. And rating means that your health condition is not average. And you have some health issues that increases the likelihood that your family may be using these benefits.
This is so diplomatic.
Yeah.
That's good.
So with that being said, this $1 million policy actually cost me at that time in 2009, $500 a month, where yours costs you $80.
Right.
Right. And then I know what I did. In 2015, I was looking at upping that. And then it actually cost, my health condition didn't change much, and it cost me $800 a month. So I think it's important for you to take away from this that getting insurance when you're young and when you're healthy is very important.
I think we want to give the audience also some ideas to go, if you find yourself in that situation, and for instance, I have a client who's diabetic and he's turning 65 this year, and for the last 15 years we've worked together, and like most of us in society today, we don't stay at one job, right? We do well, we move up, and then we go to another company, et cetera. When you go to your new company, find out your benefits enrollment. Do not sleep on your benefits enrollment, because there's typically group term coverage. And there's what's called a guaranteed issue amount. So usually they're going to give you a basic level benefit that might be 1 times, 2 times your salary. Sometimes it's a flat amount. It's $50,000, it's $100,000. But then you can go buy what they call supplemental or voluntary life insurance on top of that. And in this client's case, the first thing that we would do when we got that benefits booklet is read through it and find out what's the guaranteed issue amount. And in his case, it was usually around $300,000 that we could get without having to go through any underwriting. So to Clifton's point, he might get rated on an individual policy where you're having to do medical underwriting, but on that group coverage, we got to skirt that issue and go, we don't have to do underwriting if we stay at this amount and if you do it when you're first eligible. If you don't do it when you're first eligible and then the next year you come back to do it, they're gonna make you go through underwriting. So I think understanding where your situation is, then there's usually, financial planning is funny because there's not only one way to do things, we can find another route. And again, this goes back to the idea of some companies will rate you for that ventricle issue, some may not. Or tobacco users, right?
Yes.
So that's a really big thing in insurance underwriting. They will almost double your premiums for tobacco use. But if you can go a 2-year period and show that you have not been using tobacco, you can come back in and get on the same policy, get them to lower your rates if you go back through a medical questionnaire and things like that. So I think like Clifton did, and going back and getting it reevaluated is really important. And if you're managing your health and you're doing things to improve it, your rates could go down, right?
So the takeaways, again, the cost of insurance is based on your age, your gender, your health, your occupation sometimes. And it's important to talk to a financial advisor and reassess yourself, because if you smoke and then you stop smoking, there's a chance for you to get re-rated.
Yes.
It's important for you to understand your work benefits, to see what you can get in coverage, and if your life insurance is portable, what increase affects your, you have to show in your eligible for life, eligibility for life insurance. So there's all these different factors. But I would say outside of those things, what else goes into the cost, or whether it's temporary or permanent? affects the cost as well.
That's a big part of it. There's some other costs that are inside of a policy. So for instance, if you're in a permanent policy, a lot of times there's a premium expense that goes to the insurance company and also the state insurance commissioner. And on a permanent policy, that's typically going to run around 5% of your new premiums. So you'll notice on a permanent insurance policy, usually within the first 10 years, if you're looking at your illustration, the returns don't look really good because there are some upfront kind of heavy costs in there. And those are, again, more prevalent on the permanent side than they are on the term side. Sometimes, Clifton was mentioning the $1 million level. It's okay to get a $100,000 or $250,000 or whatever the amount is, again, going back to what your need is. But sometimes there's a policy administrative expense. And that may be waived if your policy is over a certain amount. So when Clifton and I used to work together at Ameriprise, that threshold was $250,000. If your policy was $250,000 or more, no annual administrative expense. If it was less than that, it might be $40 a year or $60 a year. And you have to factor that into the cost as well. If you're using a product as you go and look through here, if you're using like a variable universal life insurance policy, it's got mutual funds inside of it that you can invest in, and there's costs to investing in those. So there could be some other costs that are in there like that, but the main ones, like you mentioned, are based on your age, your gender. They call those the mortality expenses, and that's the biggest component of the actual cost of insurance outside of just those administrative add-ons like your premium expense and the policy expense, the admin cost.
So we're going to dive a little bit deeper into the different types of policy and permanent policy. And we're also going to talk about how we can use life insurance to generate wealth. But where we are today and what I want you to take away is having a conversation with a professional to see what your need is and having that conversation on a regular basis so you can identify as early as possible what your need is, and you can decide when should you get life insurance, because the bigger factor of cost is your age and your health condition. We can plot our age. We do not know when our health is going to change, right? And so that's one of the big takeaways I want you to take away from now. And then also when you find out what your need is and the amount, then you'll find that usually when you look at the cost of the insurance, you usually have to cover your need with a combination of temporary and permanent insurance. I do not like it when people are comparing the premium cost of a permanent policy and a temporary policy and making it seem like it's apples and apples, because it's not, and you cannot. Temporary policy is for a specific period of time. A permanent policy gives you other features, so regardless, you can't compare the cost, right? And so don't get caught into that when someone's trying to sell you on one versus the other, and they use cost as a factor. Right. So let's talk about, let's say you have $1 million need. You find that if you look at the $1 million of coverage with a permanent policy, it's just not going to work. And you have to use a combination, and then that's where you can dive into the different types of permanent policies.
Yeah, and I think in that situation, again, every client's situation is unique. And so understanding what the resources and tools they have at their disposal is important. And if we're trying to fit within a certain premium budget on a monthly basis, then we may look at that idea of going, great, what's our basic benefit through work? How cost effective is it to get 1 to 2 times salary and additional at work? If you're with a really big employer, it might be pretty cost effective. But also understand how they evaluate your rate. So a lot of times on those big employer-based policies, you'll be in rate bands for 5-year periods. And so if we're in the beginning of that 5-year period, it might be good to use that. If we're in the 4th year of the 5-year period, maybe it's better to buy that individual term that's going to stay the same for a certain period of time. And so looking at that for the term side, and then the permanent side is, to Clifton's point, what's the goal of it? And typically the goal first and foremost should be you need the life insurance coverage. If we have the subsidiary goal or secondary goal to also be able to build wealth inside of it and access that money tax-free, and it fits within your monthly savings allocation and the other things we're doing, like contributing to your 401k up to the company match and putting some money in a savings account to have 3 to 6 months worth of expenses in case I lose my job and stuff like that, or building a brokerage account or employee stock purchase plan. Lots of different things we can do. So I think the key is going, if we're going to use that permanent insurance policy, even within the same policy, like my policy at $278K, I don't have to fund it at $4,000 a year, but I want to put the most that I can in there, keep it a life insurance policy under the IRS rules, and have some money in there that I could use to help supplement what I'm doing for my kids' college. But you could also just say, well, I'm really just buying it for the death benefit, in which case I could fund it at probably $150 a month, and it'll last till I'm 100, right? So I think it's coming back to that idea of making sure that we're not taking all the flexibility out of your situation, and all of a sudden everything that you're doing is going toward an insurance premium. We have other goals. We want to take vacations with our families. We want to build wealth in other ways, and so I think that's the key.
Yeah, and the other way that advisors usually determine how much is covered with temporary versus permanent is how much insurance is needed for a period of time before it starts declining.
Right.
So if you need to pay off a mortgage, usually 30 years or so, or 15 years, kids' education, certain number of years to replace your income if you were to pass away. And so when you identify that, I do need a higher level of insurance for at least 10, 15, or 30 years, then if you look at the types of insurance handout, that again is the link under the video, or it's in front of you, there are annual renewable term, level term, decreasing term. Those are different types of temporary policies that are for a specific period of time. The premiums are lower than a permanent policy.
Keep going.
And those strategies are they're relatively simpler than understanding a permanent policy. So what I want to do now is kind of talk about the permanent policies, because you've got whole life, a universal policy, variable universal policy, and an index universal policy. And I want to address those because I believe that usually whole life, which is probably the first policy that was out there that was designed to last for someone's entire life, is sometimes given a bad rap, but I think it fits a need.
Definitely.
If you're the kind of person that wants to buy a policy and never look at it again, and just make sure you have it, as long as you're making your payments, and you want to be able to pay it off in a certain number of years, whether it's 20 years or by the time I'm 65, I don't want to make another payment, then a whole life policy might be something worth you considering, because it's very simple. You just pay the premiums, put it in your budget, and don't worry about it. But if you start looking at some of these other policies and you want more flexibility, then with flexibility comes more responsibility.
Right.
And you gotta review them on a regular basis. And I've seen so many people who got these other types of flexible policies, universal policies, and they didn't review them annually. And then when we're meeting with them, we're finding out that that policy is not going to meet the goal that they intended for it to meet.
Right.
And that's not a good conversation. So let's talk about whole life first, pros and cons, and then move on to the different types of universal policies, and we can discuss the flexibilities of them.
Yeah, and I think the way that you tee that up is perfect. I'm a big believer in financial planning, that there's not a bad product out there. There are misuses of a product. And so I think I'm going to tie it back to your example before. You buy a policy for your grandchild. I'm sure everybody's kind of seen the Gerber life policies and those kind of things. They're not bad, right? They're exactly what Clifton said. It's a stated amount for a stated period of time, and it's going to give you this level of benefit. And you can go, as long as I pay that premium, it's in place. It did exactly what it was supposed to do. That's great. Northwestern Mutual. We see Northwestern Mutual policies coming a lot from clients. They're really good, and they're super steady. Northwestern Mutual is a great company. Their whole life policies, love them. And I think, like Clifton said, the key is that thing's going to be enforced your whole life, and you can plan on that premium. You know what it's going to be. It's super simple. And there's a place in our lives sometimes for that simplicity. So I'd say that's the pro. The con to it is that the growth of the cash value inside there may not be as robust as in other places, although it depends on the year. If you have a 2008 where the market's down 37% and your whole life policy just gave you a 4% dividend, that's pretty good, right? So I think even from a diversification standpoint, a whole life, or you could even tie that into like a basic universal life policy that has a fixed rate of interest, sometimes that might be your best performer, right?
Yeah.
So I think the key, I think Clifton hit the nail on the head, is that permanent policy that's a whole life policy. Whole life is the first type of permanent policy that was created, so it is the most basic. What's happening in the background is the insurance company's taking in your money, they're going and investing it, they're going to give you a guaranteed rate of return on it, and they're going to keep the spread above that, right? So sometimes we look at that and we go, I'm good with that because you told me what I'm going to get in the way of my benefit, and I like the benefit. So have at it. By all means, be profitable and be here in 50 years when I die. That's great. Insurance company did what we're supposed to do. But if you look at it and you go, you know what, I want to leverage the growth on my assets a little bit more, and I want to be a little bit more in control, that could be a compelling reason to consider the indexed universal life or the variable life product, because I'm going to lump the basic universal life policy almost in there with, or what's called a fixed universal life policy. It's like whole life 2.0. It's going to be it's an interest rate based return, but maybe one nuance to it versus whole life is that you can change your death benefit throughout time.
Can we talk about, before we go into the universal, let's finish whole though.
Okay.
Because one of the benefits of a permanent policy, and we've talked about this, is this cash value that's growing. And you get that in a permanent policy versus a temporary policy. So you got to look at what's the purpose of that cash value. And I say the number one purpose of that cash value, when you're getting any kind of permanent policy, you're still getting a temporary policy from when you look under the hood, you're still getting, the insurance company is still providing you with a death benefit in the event that you pass away early or later. So there's a portion of that is still paying for your cost of insurance. And as you get older, your cost of insurance is going to increase because there's a little more likelihood that you're going to pass away. So when you're paying into these permanent policies and you're building up a cash value, one purpose of that cash value is to pay for your cost of insurance when either you stop paying for it and your cost goes up greater than what you were paying, right? If your premium is the same, or even if you stop paying. And so the cash value portion, the number one priority, I think, is to ensure that there's enough cash value to pay for your cost of your insurance for the rest of your life. The other goal is to give you some cash that you can take out for another purpose. Right? And so as we go into the universal policies and we're talking about flexibility, that's where you really have to look at your cash value, the level of growth, to make sure there's enough cash value in that policy to pay for your cost of insurance and give you the options if you want to take money out of it at some point in time.
Yeah, and I think a tool that's helpful on that, anytime you have a permanent policy, regardless of the type of permanent policy, I think Clifton mentioned that idea of going back and reviewing it. Ask your agent, your financial advisor, whomever you've purchased your insurance through, ask them to run what's called an in-force ledger or an in-force illustration. And it'll tell you, if I continue to pay the exact same premium, will my policy last until I'm 100 or 120 or whatever it may be? But it's kind of a way to do a health check on your policy, right? And I think like Clifton said, that's the thought is on these basic permanent policies is you're building this pool of cash value inside the policy that will take care of all the costs when you're later. They'll keep your premiums level, right? And they'll make sure your policy's still in force at the end of your life.
In this handout that is entitled Life Insurance Basics, it's on page 5 of Life Insurance Basics. It looks like this. It's 9 pages. You should have it, all of you should have it underneath. Oh, no, I'm sorry. You don't have it. I was just testing. See, are you awake? Are you awake now? It's underneath the video. So for those of you who are watching online, you can click on that. We have it up here.
And we'll give you our copy, or you can get the
we'll
PDF
give you our copy.
Well.
I'm sorry. I'm so sorry. But it's on page 5. It has an illustration that talks about the cash value account, the accumulation of it. And so definitely, if you don't have it here, if you're in the audience with us, I apologize for teasing you. But if you are watching online, you can click on the link and download it. Or if you have your phone with you, you can actually click on it beneath the video. And it has that example for the different types of permanent policy, whether it's universal, variable universal, or universal life insurance.
Yeah, and I think with that in mind, Clifton, I don't know that we go like super deep into the mechanics of them, right?
They can read later.
Yes.
Right. But talk about the strategy of how you would use a combination of temporary and permanent to meet your total need.
Yeah.
And then the value of meeting with your advisor all the time.
And maybe too, just real quick, because you had asked about a little bit more of the difference on the other types. So I think
something like this.
Yeah, this comparison, again, also, folks in the audience, you don't have this in front of you, but this is kind of a nice page too that compares the different types, right? And gives you pros and the cons of each. So rather than me reading that, you guys can read that too. But a big difference as you get into the permanent life realm, Yeah, and I'll pass this to you in just a second too. Okay, oh, you got it. Okay, so Mary, this one's yours then. Love it. For those who didn't hear, Will said he's going to put that in his survey. So in the permanent realm, we talked about whole life being kind of the basic. Then you can get into like universal life, variable life, and then there's even subsets of those too. I think the big thing to remember about universal and variable is that they're flexible. So you can change your death benefit. You can adjust the level of premium you pay on it. On a whole life policy in a term, your premium is what it is and you better pay it. And if you don't, your policy will lapse. On a universal life, I could decide not to pay any premiums into my policy this year because there's cash value inside of it, and the premiums would just be pulled out of my cash value, right? So if I lost my job, or if I decided I'm going to go on sabbatical and I'm going to go live on a beach for 6 months and not generate any income, so what? My cash value inside of my policy can pay for it. So I think that flexibility inherent in the universal or the variable is kind of nice in the realization that our lives aren't linear, like things change, right? So I think the universal and the variable policy give you some flexibility to adjust how you approach your life insurance strategy. And they also give you more inherent ability to control the investments in them. So Clifton asked for a handout on indexed universal life. It's kind of all the rage right now, which again, it's not sexy, but to insurance agents, they think it is.
You do have that in front of you, though.
Yes.
It's a one-sheeter.
Yes. Put that on your survey, please. The indexed component, it's kind of cool. I don't want to go into great detail on it, but it's just another variation of how to invest, right? So what the index means is you get the performance of an underlying component of the market when things are good. So for instance, if we used an S&P 500 index, which are the top 500 companies in the US based on size. And if that index were up 10%, then you can get that 10% on that sub-account within your policy. If it's 2008 and the S&P is down 37%, the index says you just don't get any return. You get a 0, but you don't get negative 37. So it kind of gives you the upside potential without the downside, and the way they're able to do that is they'll cap your performance on the upside. So back to the idea of the 10, maybe the S&P did 10 and they're gonna go, great, you're gonna get 8 of that. We're gonna get to keep 2, right? And so you can get really complex really quickly and talk about participation rates and multiples and cap rates and all these kind of things. And these are important pieces to understand. And this goes back to the concept of when you start to choose to go into the universal and the variable life component, you are taking more responsibility for knowing I need to be managing this thing more frequently. And it doesn't mean you need to be an expert, but you need to be a partner with whomever is helping you manage it and make sure it's continuing to be managed in a manner that's appropriate for you.
Exactly. So here's the thing too. It's important to know that everything that we're talking about is strictly for educational and informational purposes. We should have started with that.
My compliance department.
What we want to inspire you to take is scheduling the time to meet with a financial professional to go over this in more detail.
I think too, as you're meeting with financial professionals, and majority of you probably already have one or many with whom you're already working, and if it's somebody that you know and that you trust, use them, right? Ideally, they're spending a lot of time learning this stuff and they can pass that knowledge on to you. And if you don't have one yet, there's not any one place to go to get them. There's a lot of great advisors out there in a lot of different places. Make sure whoever it is, you feel comfortable asking questions to them.
Oh, yeah.
And I think like Clifton said, one of the things that makes him leery is when somebody says, you got to do this all this way. If there's one thing I can tell you is that there are multiple ways to accomplish a goal in financial planning. We've talked about the idea of group insurance, individual insurance. If I'm not willing as an advisor to talk to you about your group policies and the fact that there are some cool things in there like guaranteed issue that you can't get on the individual side, it might be that I'm looking after my own interests a little bit more than I'm looking in yours because I want that commission from the insurance policy, right? There's nothing wrong with an agent selling you a policy because by then selling you a policy, you get the coverage you need. But we just want to make sure it's the right fit for you and for what your goals are. So I think that's the key. Find somebody that you trust, that you know is out there to help you get to your goals. They're going to get paid in the process, and we want that because we want them to be here in 20 years when your term expires and you got to figure out what's next. But we want to know that they're objective and they're looking at all the pieces you have available, not looking at every problem like it's a nail and the hammer that they have is the only way to solve it, right?
Yeah, and so a couple of experiences. Whoever I bring to you is trustworthy. And so Adam, my guy, right? But there's Mark Howard is a New York life insurance agent. And so he's met with certain clients who's had other policies that they were looking at. There was a policy that was a veteran, that was only veterans were eligible for. And none of the policies or insurance policies he had could compete with that. So it wasn't like he was just going to recommend what was going to get him paid. He actually was able to educate this client on the different features and said at the present moment, out of all of your choices, this veterans policy is the best one for you. So you want to meet with someone that has your best interests at heart, that you can trust. Journey to Cloud 9, that's a person who's watching online, has a comment and a question, and we're going to lead into how you can use life insurance to create generational wealth. The comment is, my grandfather had a policy so his burial expenses were covered. No other family members have life insurance that I'm aware of. So when someone dies, we pull together funds to pay for expenses out of pocket. But if a person doesn't own real estate, nor children, et cetera, like he's thinking that there's not a need. Go ahead.
I was just going to say, I think that's a beautiful example of going, you don't have to rely on life insurance to cover a need. Like, if we as a community of Americans took care of each other like that, we could argue we would be a lot less reliant on the government too, right? Like, what a beautiful thing to go, hey, that's all of our responsibilities, right? And I think in a Western culture, we tend to be more individualistic, and we tend to think I need to button it all up and take care of it all myself. I think that's awesome.
Or even the thought that I need to leave money for other people. At the end of the day, everything we have, life is the least, the physical stuff is least, right? We ain't taking none of this with us.
Amen.
There's no U-Haul behind a hearse.
Except in Arkansas. I'm just kidding. I love you, Arkansas.
So the money we make, right? The money we make, we're going to spend it on something, right? We're going to spend it on either future goals or living expenses today. And when we pass away, we're giving it to whoever's left, right? Whoever's our surviving loved ones. That being said, a lot of the thought around permanent life insurance is the cash value buildup and how that can generate wealth for people. I look at, my personal thought on this is that life insurance is not for me, it's for my loved ones. So whether it's the death benefit or even the cash value, pulling out cash value from a permanent life insurance policy typically reduces the death benefit. Mm-hmm. And so again, it goes back to building wealth and generational wealth with life insurance. To me, is more so passing that wealth on to future generations. Is with the death benefit and any cash value that's in it, and it's not so much building up wealth for me. Bless you. So the way I look at life insurance is creating generational wealth is passing it on. Mm-hmm. And for me to create wealth, it's what am I doing with my money today? You know, am I investing it in revenue producing or asset appreciation or assets that appreciate in value? And can I pass those assets on to my future generations? What are your thoughts about the use of the cash value for your immediate expenses, your future expenses of retirement or education versus just keeping that in the policy and passing it on to your beneficiaries?
Yeah, and I don't even know that it has to be one or the other. I don't know that it's a mutually exclusive concept. Mm-hmm. But I think we talked about this before the program started, is just the reliance on a policy to fulfill all your needs maybe is a little overweighting on that.
Maybe?
Yeah. I was trying to be diplomatic.
Right.
But I think there's so many ways to pass on wealth, right? One of the cool things about like real estate that we have, or if we've built money in a brokerage account, is at our passing, it gets what's called a step up in basis. So we're going to lean a little bit into tax planning to come back into insurance, because in financial planning, everything's kind of interwoven, right? So at our passing with that real estate, it tends to get a step up in basis. So let's say I bought it at $100,000, but now we've been in the Dallas-Fort Worth area and properties have gone crazy, and so now it's $500,000 in value. Well, if I sold that today, I'd have to pay capital gains tax potentially on that $400,000 difference, unless it's my primary residence and you can shelter gains and certain things like that. But for my heirs, at my passing, their basis becomes that $500,000 value on the date of my death. So they get that property and they can sell it the next day, and there's no capital gains tax because their basis becomes that $500,000 value. That's a pretty cool way to pass wealth that's technically income tax free, just like a death benefit from a life insurance policy. I will tell you there's complexity to that. When we get over a certain level of net worth, estate tax comes back into play. The way that we title the asset becomes important. Are we in a community property state? Are we in a common law state? Those things all have an effect, right? But all this to come back and say, as a means of building wealth and utilizing it, life insurance can be a great piece to that, but it's not the only way to do it. So we encourage you to kind of diversify, look into some other options. I think as the wealth transfer feature, it is good. It is one of the life insurance lobby is big. And so there's some really cool features to that tax-free side of it that will probably, knock on wood, should be here for the rest of our lives and then some, because the insurance lobby has a lot of money and they keep pushing Congress to keep it the way that it is. I think in terms of the utilization of the cash value inside of the policy, I use it for that. We have clients that use it for that, but it's never, that's the only thing that we're doing. It's always in conjunction with other things. It's not the cake, it's the icing on the cake, and it gives us flexibility. Again, back to that idea of, if we got a lot of money in real estate and then all of a sudden we go through a 2008 level event where liquidity dries up and people are getting their houses foreclosed on, I might not want to be selling my real estate that year to accomplish a goal. I could take money out of my cash value life insurance policy that's going up in value. That would be a good time to be able to use it, right? So I think having it as a tool in your toolkit is helpful, but maybe it's not like your only lifesaver, right?
Yeah. So the way I look at it is this: if we are taking money out of our life insurance policy to take care of retirement expenses, I look at that as the last bucket that should be pulled upon. There should be other buckets that are pulled upon first. That's number one. And then secondly, let's talk about a situation that most families might find themselves in. Talking about real estate, maybe our grandparents or our parents have bought property and it's very valuable now. And my term is being patient or having patient money. So people who are playing in this real estate game, especially development, they have to be patient to let that property sit, increase in value, let the population continue to grow so that that property now is going to be used for either commercial purposes or residential purposes. So you have to be patient. So if someone has passed away and has left property to beneficiaries and they don't have the cash flow or the liquidity to hold onto that property, pay the property taxes, then that's how life insurance can be used. So we talked about the need for life insurance in the very beginning, maybe being need to take care of our children or people who are dependent upon our income, but then life insurance can be used as a tool to create generational wealth by providing liquidity to an estate to maintain and hold on to assets instead of selling them at distress, right?
I think that's a great point. And I think, again, evaluating the situation of the beneficiaries, the asset itself. So let's say it's a family house that passes to the heirs, and one of the heirs maybe doesn't want to be a continued heir in it. So now all of a sudden you've brought together 3 brothers and sisters and 2 cousins that are all owners, and the cousins are like, dude, I live 14 states away. I don't want anything to do with that. That life insurance could help the other beneficiaries buy those cousins' interest out, keep the family asset, keep the other 2 cousins happy, right? So that flexibility comes with the liquidity on it. It's hard to give them a room of the house and go, cool, take it to New Hampshire. You can't do that, but you can give them a portion of the life insurance proceeds.
I'll give you an example. My kids, right? I have a 24-year-old and a 38-year-old. So none of them want my loft downtown Dallas, right? My son's like, no, I don't see myself living in Dallas. I don't want it. I would probably rent it out. My daughter, she'll probably want to live in it free, right? Like, so at the end of the day, I have to make sure that if I want that my property to be of benefit to them, I want to make sure, number one, that the mortgage is paid off, but there's liquidity to take care of property taxes and HOA, which is downtown is crazy, right?
Right.
And so if I don't do that, then what I'm really leaving them is a headache. I'm leaving them something that they have to. Okay, my son is in Boston getting a master's in architecture and design. He's trying to figure out how to pay for his life. My daughter is an artist doing the same thing. They don't want the added burden of figuring out how do I maintain dad's loft in Dallas when I don't really need it. So then they'll try to sell it and probably not get the value for it that they need. And I don't know how many of you out there are in that type of situation, but this is where life insurance can be used to ensure that there's enough liquidity to maintain that asset and maybe give them the tool set, or maybe you can even build a trust. We didn't talk about the irrevocable life insurance trust, right? But to have enough liquidity in a trust that can manage property or assets with a trustee to benefit your beneficiaries and not have it be a burden to them.
Yeah, and an easy example of that, we've got a client down in Houston who's got property in Houston, Galveston, and Michigan, because he grew up in the Detroit area. And no children of his own, but lots of brothers and sisters and nieces and nephews to whom he's leaving real estate. And one of the things we talked about is this exact concept is, Mr. Client, you're in great shape and you have plenty of liquidity, but if you're leaving different assets to different people, we don't know their situation. So we created, and in this case, it's just a regular revocable trust. It doesn't have to be an irrevocable life insurance trust. That is a really cool type of trust, but it could just be a plain vanilla revocable trust with those people as the beneficiaries. And you can title other liquid assets in the name of the trust, and it could be life insurance proceeds. It could just be, I put a $30,000 savings account into that because I know it costs me about $2,000 a month to maintain these properties, even though the mortgage is paid off. So this is giving my beneficiaries a runway to kind of figure their stuff out. Am I going to do it for the rest of their lives? No, they're grown kids. Like, they need to figure their stuff out. I'm just going to give them some runway, right? And I think that's the key, is to having had the conversation.
Yeah.
It wasn't, hey, we just haphazardly gave this to them, but we gave it to them with a plan in place. And maybe part of it is you're like, you know what? I don't care.
Right.
Like, I'm giving them an asset. They can figure it out. And if they have to sell it for less than it's worth, who cares? They're still going to get something.
That's what some people think too.
Which is okay. And I think, but having had the conversation, I think is the key. Kind of like was it Cloud9?
Yeah.
Like, that idea was awesome too, right? And it's like, well, cool, your community's there. You don't need the life insurance, right?
So hey, we've talked about some things that we think are important to have, conversations with your financial advisor. Do you have any specific questions? I know Mary has some questions. Are there any questions in the audience or even online? If you have any questions online that we haven't addressed, now's the time to ask it. You can also put it in the live chat, in the comment section. Live chat is what I'm looking at now. The comment section, you can also put it in, and we'll definitely get back with you. But are there any questions? Oh yeah, what's up, my man?
Okay, can you guys hear me?
Yes, sir.
Yeah, we can hear you.
And he'll repeat it anyways because he's on the mic.
I don't know if this has been addressed. I have a couple of friends that sell life insurance, and I think sometimes it kind of gets caught in just the sales parts of things. I know the importance, I mean, some companies like, PHP, some companies like that, but it just seems more about just about the sales. But how do you, what is the delicate balance between, them trying to make a sale and you meeting your needs as an individual or business, as far as insurance is? Because a lot of times they sell the IUL and, they can vote against it. And then also they use a lot of fear-based tactics, stuff like that, So what is that balance when you're looking for life insurance and, and it's just like, and it's not just PHP, it's just like a lot of friends that I have sell it, but how do I know what's the difference between, the different things
So let me repeat your question. Make sure I get it right. You can go first. I'll go last because he's the expert. Number one is how can you discern when you're meeting with an insurance person whether their recommendation is really more tailored to getting them paid as opposed to being in your best interest? Is that what you're asking?
Yes.
Okay.
Yeah, I think
How would you
I think that's probably the question in all of our minds, whether it's insurance or I don't know anything about cars. When I go to the mechanic and the guy's telling me I need to do this, that, and the other, and I'm going, do I really need to do that? Is it my car that you looked at? Or are you looking at mileage and going, well, every car this mileage, we recommend this, right? So I think if you can go in with some degree of information to start with, and the beauty is, Clifton mentioned this before, nobody can tell you your need, you get to define it, right? So to your point, they may be bringing fear toward you, but you may look at it and go, well, what are you going to them for life insurance for in the first place? And if you can define, what I always start with clients is, what do you want to see happen if you're not here tomorrow? As you answer that question, then you can start to kind of put the numbers to that. And ideally that agent is helping you arrive at the number, but you can also kind of do the back of the napkin math and come up with some round numbers on the amount that you're going to want to need or want. And you should feel comfortable asking questions that will help dispel your skepticism around what their motivation is. Don't be afraid to ask them their commission. In every illustration, there should be a page that shows the commission the insurance agent's going to get, and it's okay for the insurance agent to get a commission. That's how they make their money, right? But if they're giving you these different options and they keep pushing you to the index universal life is always going to have a bigger commission than the term policy. That's okay. There should be more maintenance that agent is doing with you and more ongoing service. So they should be giving you more value for the commission that they're earning. And it's also not that index universal is right and term is wrong, right? I think that's a big piece of it too. If they're not willing to say there's a valid place for the term policy and they only think index universal life is the way to solve every need, maybe that's a red flag to say, I appreciate that. I'm going to get a second opinion, right? And get a second opinion. Like if a doctor told you that you needed surgery, you're probably going to go, cool, but before you cut me open, I'm going to go talk to another doctor and get their opinion too. And you might get different options. So I would say, in my mind, the two tools that you have to help reduce that likelihood of being taken advantage of, do some thinking before you go in there on why you're going in there in the first place. What do you feel your needs are? And then number two is, if you're not comfortable asking questions, that might not be the right agent.
Yeah.
Is that fair?
Yeah.
Okay.
Do you have a pad? There's a pad up here. I want you to take some notes. So if you don't have a pad, yeah, I want you to take notes on what we're going to say, because note takers are money makers, right?
And all of this is true because it rhymes.
So in addition to everything that Adam said, number one, in the very beginning, we talked about nobody can tell you what your needs are. We can ask you questions, you can put thought to it, but if someone is telling you what your needs are, that's a sign, right? Definitely, work with someone that you feel comfortable asking questions. The other thing is, follow your gut. Your gut tells you everything. That's why it's so important to build a relationship with financial professionals before you need them. One of the things that I say, when I was a financial advisor meeting with clients, I would give my recommendation, and I would encourage them to go talk to somebody else. Please do. I said, look, I'm not going to fire you. You can always fire me, and I'm down for open relationships. I'm like John Legend. I'll be the best she ever had. So I'm not because. And so you need to feel like your advisor is okay with you. They're not going to try to encourage you not to see somebody else, because you got to be comfortable with the recommendation.
Right.
All right. So follow all of those rules, and I think you'll find the right one. Anybody who has spoken at the Empower series is someone that I feel that I know is trustworthy, and is going to give you recommendations in your best interest. So a part of what we always deliver is connecting you to resources, so use that.
I think too, accountability and peer accountability and that idea of you getting a second opinion, if that's intimidating to the advisor, that may also be a sign that they're maybe not as confident in what they're recommending. If they're confident what they're recommending is in your best interest, they should feel really confident that as you go to other advisors, that it's going to be upheld, whether it's another insurance agent or whether it's your CPA or whatever. I look at that and I'm like, anytime we can get multiple professionals in the same room on the same call for a client, the client's going to get the best answer, because the CPA may look at it differently than I do and have different biases than I do, right? The attorney may look at it differently and have different biases, right? And I think that's advisors are not infallible.
Right.
Hopefully your advisor is self-aware enough to tell you what their biases are too, right? And that's a big part of it. So,
And I'll leave you with this. My bias is that when you're looking at life insurance is for life insurance. It's for somebody else. There's an added cash value, but that's not the primary benefit. So if you're talking to an advisor and the primary reason they're telling you to buy life insurance is because of the cash value, in me, that's a sign. Because the primary reason should always be the beneficiary, the death benefit, and then the cash value is a secondary benefit, right? And that's a legal thing, isn't it?
Right.
Like you shouldn't be buying life insurance for investment purposes when it's a life insurance product.
right.
Right.
Yeah, it can be a component of it. It's
a component, but it's not the main reason, right? Now I have another question online. Thank you for your patience, Victoria. But here's a question. I am close to 70 years old. What type of life insurance would you recommend for someone my age? So we're not giving recommendations. We're giving education and information only. We would encourage you to meet with a financial advisor. However, we can talk to you about generally our experiences with clients who are in that range. So what would you say?
I think, Victoria, first of all, as me giving you an answer to that is presuming that you even need life insurance at 70. Maybe your home is paid off and maybe your children are doing great and they don't need anything. Maybe you want the life insurance policy, in which case, great. There's so many different kinds. There's what's called second to die policies. If Victoria is married and she has a spouse, you can get a policy that's based on both of your lives. And typically, the more lives we bring in, the higher the likelihood that one of you is going to live a little bit longer. So the insurance company will give you a lower premium on it, right? And so that could be helpful, especially if it's a legacy or wealth building deal. A second to die policy we usually get as an estate planning piece to give kids money or whomever else when we're both passing, right? Because second to die means when the first spouse passes, death benefit doesn't get paid out. It gets paid out when the second one dies, which is telling you that the surviving spouse doesn't need the death benefit, right? It's meant for the next of heirs. So, Victoria, I love your question, and I don't think because you're 70, you're excluded from being able to get life insurance. You can go get it. Your premiums are going to be a little bit more expensive, so we may need to be a little bit more tactical on how we go about getting you coverage. But I would always come back to that idea of starting with, do you need coverage? And why do you want coverage? Right. And are there other ways within her own situation that we could take care of things?
Yeah, and I would add to that, in my experience when I was an agent for a company that provided life insurance, one of the things I found is that temporary life insurance, and we had talked about that earlier, temporary life insurance, if I get this right, is not really designed for people beyond the age of 70. So when you're 70 years old, it would be very rare that you can go to a life insurance company and find a temporary policy.
Right.
It would be some type of permanent policy. And even in let's say you're 60, if you wanted to get, and we talked about term policies are either 5, 10, 15, 20. If you're 60 years old, the longest term policy you can probably get is a 10-year term policy. You probably will not be able to get a 20-year term policy because that gets you into your 80s. So there are different criteria. Mm-hmm. Definitely worth sitting down with a financial advisor or a life insurance agent and see what your need is and to talk about different strategies covering it. But I wouldn't say that there's we have a recommendation of this is the type of policy that you need. We want to look what your goals are, what your need is, and then let's talk about strategies for accomplishing that need, whether it's a life insurance policy or any other type of a policy. Right. But great question. Your question was not just for you, it was for everybody who's at that point. So thank you for being courageous enough to ask your question. Any other questions? Those are great two questions.
Ooh, can I add one thing for Victoria, and how much less expensive it is if you're deemed amazingly healthy? But if you're maybe a little bit less healthy than the average and it's a higher premium, we'd want to know that before we agree to start paying premiums. So what I would tell Victoria is, if you're going to assess whether life insurance is a good fit, have them do the underwriting. Have them do the underwriting, come back to you with an actual offer based on you, and then she can make an informed decision whether or not she wants to get it, because she could get an illustration that says one thing and then go through underwriting and it says another, and then all of a sudden this changes the situation. I would rather her know fully what it's going to look like based on that stuff. And again, the company gets to offer you. You don't have to accept it. Just because you went through underwriting, you may go, not worth that premium, or you may go, actually, that was great. Like, get it. Let's proceed.
And to add to that, another good thing to determine whether your advisor is more of a sales agent or an advisor giving you advice in your best interest is when you are submitting your application for life insurance. As Adam said, you can submit that with the premium payment, which gives you coverage at an earlier point in time, or just submit the application without a premium payment and wait to see if you are qualified and at what rate before you make your premium payment. That's very important to do, because as a salesperson, we want to try to get you covered sooner than later. And they can ask you to submit a premium payment, but you don't have to. And when you're comparing policies, it's important to know what is it called, the health condition or the risk, the level that they're submitting it at. Is it?
Oh, yes. Yeah, the underwriting class.
Your underwriting class, because someone may quote you like being in the best health, which is the lowest premium, and it's a rarity that people get the best health. And so when you're comparing policies and you got a best health rate and you're comparing to someone else who has an average rate, that's not apples and apples. So knowing what the health rate is very important.
And I think also, back to that idea of, like, very rarely is there a finite answer in finance, and submitting a premium with the app is not a horrible thing, right? Especially, I'm getting this application going and I've got to go out of the country for X amount of time, and I want that coverage to be in place, assuming my underwriting goes right. Immediately, me submitting that premium enables that coverage to be in place quicker. So it's not to say that it's a bad thing, but it's, again, a case-by-case situation. And if she's evaluating it against her other options, she may not need the coverage immediately. Somebody else may say, man, I got 47 trips booked in the next 2 weeks. I got to go travel for business. I'm a consultant. Maybe you do submit your premium with your policy, right? So that if you can't get back in to see that agent and your underwriting went smoothly, then your coverage is effective from day one, right? So it's kind of weird. There's give and take. But there's not necessarily one right way to do it.
Yeah. So again, we're open for questions. I'll tell you that in every workshop, there's 4 things I want to get across. And also, I also have some books too. so instead of me telling you what the 4 things are, I'm going to tell you about the 2 books that I want to give away to anyone who can answer some questions I have for you. So number 1, we had a speaker named Rock T. He's a radio personality, and he has spoken at our Empower series a number of times. If you go to our YouTube channel and type Rock T and Empower series, you'll see his shorts and his talk. But last year he talked about getting it done, no excuses. Just get it done, taking action. So there's a book here. I have 2 books called No Excuses, Get It Done by Rock T. And then I have several books by Wendy Ida. And how many people know who Wendy Ida is? Raise your hand. Not many, right? So Wendy Ida, this book was written a while ago. She was actually 60 in this book, but she's 72 now, and she doesn't look it. She is a domestic violence survivor, and is a fitness. She holds a Guinness Book of World Records for the number of burpees for her age. Wow. And she is just a fitness guru. And she has a book here, Take Back Your Life. The byline says, my no-nonsense approach to health, fitness, and looking good naked.
That's way sexier than insurance planning.
So I have a number of her books here. She's actually autographed them saying, be empowered, lot of love, Wendy Ida. And so I have several books here, and I'm going to give them away to people either online who can answer these questions or people who are here. And can somebody give me one or the 4 things that we do in every Empower series?
Sources.
Right. I love that. Anybody else? Anybody else want to shoot? Give me a shot. I'll tell you, and you can make notes because note takers are money makers.
I was raising my hand.
Oh, I'm sorry. I wasn't even looking at you,
on,
man.
man.
Do you count, though?
You can't give me the book, but I
All
wanted to
right.
answer.
Well, okay, what would you say it is?
I like that hope was in there, right? You want to give them hope.
Hope is one. So we want to give you hope. We want to inspire you to take some type of action. There's 2 more.
Okay, well, utilize your resources through your network.
Right? So that's connections. So connecting you to resources.
Mary gets a book.
So Mary gets a book, and you can choose. So anybody else? You want to give it a shot? Give it a shot. What do you think, man? Just give it a shot. Yeah.
Expand your knowledge.
Okay. So here, there's 4 things we want you to do. We want to give you hope that you can achieve whatever goal you want to achieve. We want to make sure that we're inspiring you to take action. We want to educate you, right? We want to educate you, and we want to connect you to resources to help you take that next step. So because of that, share with me what are the things you're going to do as a result of this workshop. And everybody can say what they're going to do. If it's nothing, you can say nothing. But what are you going to do as a result of this workshop?
Meet with the financial
Yeah.
planner.
Meet with the financial advisor. Okay, what else?
Same thing with talk with the financial advisor about my situation and see what will work for me.
Okay. Well, what are you going to do?
Oh, I gotta go back and pull my insurance stuff and take a look at it, refresh my.
That's great. So really take a look at your current policies and really understand them.
Right.
Okay, I like that. So rethinking your approach to life insurance and maybe sitting down and talking to somebody about it. Okay, I got it.
Look at my coverage and, talk to an advisor. But, well, I'm glad I talked to you guys today, but now I have better understanding and not getting into over here. You're just trying to get a sale or whatever.
Right.
What works for me, right? What's in it for me?
Yes.
Well, I want to thank you all for coming. I want to thank you all for tuning in and watching on a Saturday morning. But I need your help, right? So a lot of times you may be in the situation that I've been in where you're helping other people a lot, and then when someone offers to help you, you're Adam for really taking time out of his life because he is busy. He has a very successful practice during the week. He has a family with children, and weekends are for them. I am so thankful that you've taken time away from your family on this weekend to pour into our community. So I want to show Adam our love and appreciation for that. So thank you.
Man. Can I just echo that back? I think, again, like we work with advisors that we know and we trust and that we like. And I think your charisma speaks for itself. Anytime Clifton calls me and there's an opportunity to get to collaborate with this guy, I'm going to move things around to do it. I always feel humbled too because I'm like, Clifton, I feel like I can get you a way better person than myself to be out here. But selfishly, I'm like, but I want to hang with Clifton. And this
He's a cool brother. He's cool. And man, yeah, we have fun, man. I appreciate you really asking me to be a part of this too, because I would have been really good being in the background. But thank you, thank you. So,
Amen.
so Adam helps as well as all of the other speakers that I bring, as well as you coming on and watching. So here's what I need help with. And it's amazing when I look at what becomes viral. It's usually a lot of negativity, right? The mission of the Empower series is to provide a positive impact in the world by inspiring people to thrive in every area. So we do workshops on the 3rd Saturday of every month. We've been doing that since April of 2011, and for 13 years, right? But the way we can get this to really be impactful and global is if you take what you've learned now and share it with somebody else. So if you learn something, teach it. So whatever you got today, don't keep it to yourself. Share it with somebody else. that is one of the biggest things you can do.
Clifton, I think too, like I'm a big believer in the minute that we walk out of this door, I'm not the only one that's busy. You guys are all busy,
Yeah,
right?
yeah.
We're husbands, we're wives, we're dads, sons, whatever. These resources and your notes, there's gonna be one thing on these resources that's gonna spark that memory to go, oh yeah, I need to find out, does my term have a conversion feature, right? This is an easy thing to share rather than you telling somebody else maybe the exact reason that this was impactful for you. You could just say it was impactful and go, dude, check out his YouTube channel,
Right.
or look at one of these resources, right? Or just for ourselves. Like I have to go back and reread this stuff, and I do it for a living. So
I love it.
use these have shelf life. Use them.
Yeah, so we'll give you handouts. If you're watching online, the links to the bottom of the video. And the other thing is to share this, share the Empower series. Do not keep it to yourself, and connect with us. Stay connected, because we're here to empower you. So if you have any questions, don't hesitate to reach out to me at thrive@empowerseries.com. Put a comment on any of our social media platforms, whether it's LinkedIn, Facebook, Instagram, YouTube, whatever that might be. Help me help you. Help me empower you. So thank you. Until we meet again, be empowered and inspired to thrive.
And I hope Clifton is a write-in candidate at some point for president, because I will vote for this guy.
Hey.